Thanks for clicking. Canada's fixed mortgage rates fell significantly this month as investors pile into the safety of U.S. Treasuries and Canadian government bonds amid increasing worries over the state of the global economy.
Good things happen to good people.
Indeed, with the fall of Silicon Valley Bank, which we talked about last week, the bailout of Credit Suisse, and just recently news that the Bank of Canada will be joining the other central banks in strengthening the swap lines as global liquidity dries up, uncertainty is definitely growing about the strength of our financial institutions.
Our markets solid.
And when markets are uncertain, investors pile into government bonds, which, as we'll see, leads to lower mortgage rates. So what I want to do today is go over my best mortgage rates for the month of March, take a look at what is pushing these rates down and why it might not last, and then discuss what to look for next. Speaking of next, Canada's inflation data for the month of February is set to be released tomorrow, and many are predicting, and Bank of Canada Governor Tiff Macklem is no doubt hoping, that it will be coming in slower in February. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. On to the mortgage rates. First off, the best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you have less than 20% down. You have a 25-year amortization. You qualify at 5.25% or the contract rate plus 2%, whichever is higher. And you pay the mortgage insurance. The best 5-year fixed insured mortgage rate was sitting at 4.79% in January. That bumped up to 4.99% in February and came all the way back down in March to 4.64%, with a 5-year insured variable mortgage rate sitting at prime minus 1.05 or 5.65%. And my best 5-year insurable mortgage rates are also down in March. Insurable mortgage rate, if you'll remember, that's where you do have that 20% down payment. You qualify with a 25-year amortization and an interest rate of 5.25% or 2 points above the contract rate, and you don't pay the mortgage insurance. My best insurable mortgage rate in January was sitting at 5.14. That bumped up to 5.19 in February, and as of March is now sitting at 4.89%. with a 5-year variable mortgage rate sitting at prime minus 0.5 or 6.2%. And finally, uninsurable mortgage rates. Uninsurable mortgage rates, if you remember, that's where you have at least 20% down. You either take money out of your home vis-a-vis an equity takeout or a refinance. You have a 30-year amortization, and you don't pay the mortgage insurance. Unlike insured and insurable, uninsured mortgage rates have stayed largely the same, sitting at 5.14 in January, and then 5.14 in February, and then 5.14 in March, with a 5-year variable uninsurable mortgage rate sitting at prime minus 0.4 or 6.3%. So 5-year insured mortgage rates down about 35 basis points, insurable mortgage rates down about a quarter point, and uninsurable mortgage rates with a 30-year amortization or taking money out of your home remaining largely static. And these significant decreases in mortgage rates are due in large part to the turmoil that we're seeing in the global economy, as investors look to take their money out of equities, take their money out of the banks, and pour them into government bonds. Government bonds which, for now at least, are seen as the most safe investment on earth. Governments have a money printer, as well as a monopoly on the use of force.
They come in handy.
And as we've talked about before on this channel, and will very briefly again right now, the price of bonds and their yields are inversely related. As bond prices go up, yields fall. Very briefly, if I have a bond from the government that costs $100 and has a coupon rate or an interest rate of $10, at maturity I will get $110. I will have yielded or earned $10 on that bond. The yield on that is 10%. However, I might have that bond yielding 10%, but Sharon really needs a safe place to put her money. She doesn't trust the banks.
That makes sense.
Yeah.
So, Sharon offers to give me $105 for that bond. I take the money, as I don't have to wait to get my money. I don't have to wait until that bond matures. Sharon has a safe place to put her money, but Sharon paid $105 to get $110 when that bond matures. So Sharon is only yielding 4.65%. She paid more for that bond, so she is yielding less. And that simplified version is what's been happening with bonds right now. As investors look to pull their money out of the market, pull their money from wherever and put it into the safety of bonds, the prices of those bonds go up. And when the prices of those bonds go up, the yields fall. And since the banks largely price mortgage rates based off the yields they can get on a government bond, charging a bit more for a mortgage than they can get from a bond, as homeowners are less likely to make their payments than our governments, mortgage rates have been falling as well. And it's not just fixed rates that are seeing this downward pressure, with many predicting that the central banks will have to reverse course as the turmoil in the markets unfold. Indeed, following the collapse of Silicon Valley Bank, predictions that the central banks would have to reverse began flooding in almost immediately, with Rob Carrick of the Globe and Mail calling the SVB collapse the best news in ages. Carrick noted in the article that fear of economic instability could cause the Bank of Canada to lower rates as early as spring or summer. And this sentiment that the central banks would have to reverse course on interest rates, that the Fed, that the Bank of Canada, that the other central banks would have to reverse course, was propagated over multiple news sources over the past week since this banking crisis began. Yet it's not clear that the central banks are going to be done hiking rates, with many still arguing that the banks will need to do more to tame inflation. Indeed, it's easy to forget that just prior to the Silicon Valley banking crisis in the US, Fed Chairman Jerome Powell said that the Fed was going to have to go higher on interest rates, and it was going to have to accelerate the pace of its interest rate hikes. And given that information that the Fed was planning on going higher and faster on interest rates just a few weeks ago, should the Fed decide to pause now, it could be a very clear signal to the markets that there's more trouble ahead than Fed officials, than government officials are letting on. And not only would a Fed pause send a signal to the markets that things may be worse than officials are letting on, that's not even to mention that inflation is still sitting at 6% in the US, and Canada is not that far behind. So the Fed and the Bank of Canada, and the majority of the central banks for that matter, are in a real rock and a hard place.
Does that suck?
Cracks are starting to show in the financial system, in the banking system, which is obviously putting a lot of pressure on the central banks to stop raising rates, stop putting that pressure on the financial system. But at the same time, we have a CPI sitting at 6%, and that is severely limiting the options available to these central banks. So, in summary, 5-year fixed mortgage rates are down significantly since last month as investors pile into government bonds, which pushes yields lower. Although many are predicting that the central banks will have to pause to stave off a crisis in the financial system, there are increasing worries that such a pause could signal to the markets that things are worse than they seem, and thereby end up being a self-reinforcing loop, a self-fulfilling prophecy. With that said, the options available to the Bank of Canada will become much more clear tomorrow when we do get that inflation data out from Stats Canada, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.